When a borrower applies for a loan, they are required to make certain statements known as declarations. These declarations provide important information to the lender regarding the borrower's financial history, current situation, and ability to repay the loan. The declarations typically cover a range of topics including any outstanding judgments, bankruptcies, foreclosures, lawsuits, defaults, delinquencies, alimony or child support payments, down payment sources, co-signed loans, and immigration status. By disclosing this information, the lender can assess the borrower's creditworthiness and determine the level of risk associated with lending to them. For instance, if a borrower has a history of defaulting on loans or has outstanding judgments against them, the lender may view them as a higher-risk borrower and adjust the loan terms accordingly. Additionally, the borrower must disclose their occupancy and ownership interest in the property being financed, as this information helps the lender evaluate the risk of default and comply with occupancy requirements. For example, if the borrower plans to use the property as a primary residence, they may be viewed as a lower-risk borrower compared to an investor who plans to rent out the property. Overall, declarations on loan applications provide transparency and help lenders make informed decisions when evaluating loan applications. It is important for borrowers to be honest and thorough in their disclosures to avoid any legal or financial repercussions in the future. Here are some common declarations that a borrower might have to make. Judgments. If a court has ordered the borrower to pay a debt, they have to tell the lender. This helps the lender see if the borrower can pay the loan back. Bankruptcy. If the borrower has gone through bankruptcy in the past, they have to tell the lender. This helps the lender understand the borrower's financial history and ability to repay the loan. Foreclosure. If the borrower has lost a property due to not paying a loan, they have to tell the lender. This helps the lender evaluate the borrower's risk of default. Deed in lieu of foreclosure. If the borrower has given a property to the lender to avoid foreclosure, they have to tell the lender. This helps the lender understand the borrower's financial history and risk of default. Lawsuits. If the borrower is currently involved in a legal case, they have to tell the lender. This helps the lender understand the borrower's financial situation and ability to repay the loan. Defaults. If the borrower has not paid a debt in the past, they have to tell the lender. This helps the lender evaluate the borrower's risk of defaulting on the loan. Delinquency. If the borrower is behind on paying debts or bills, they have to tell the lender. This helps the lender understand the borrower's financial situation and risk of default. Alimony, child support, and separate maintenance. If the borrower has to pay these types of expenses, they have to tell the lender. This helps the lender see if the borrower can afford to repay the loan. Down payment borrowed. If the borrower is borrowing money for the down payment, they have to tell the lender. This helps the lender evaluate the borrower's financial situation and risk of default. Co-maker/endorser on a note. If the borrower has co-signed or endorsed a loan for someone else, they have to tell the lender. This helps the lender understand the borrower's financial obligations and risk of default. Immigration status. Borrowers have to say whether they are a citizen or a permanent resident alien. This helps the lender follow the laws about lending to non-citizens. Occupancy and ownership interest. Borrowers have to say whether they will live in the property and how much of the property they own. This helps the lender understand the risk of default and whether the borrower meets occupancy requirements.